The world of ETFs is constantly changing, and today I'm finally revealing a move I've been planning for months. Yes, after years of holding, watching, reinvesting, and defending this position, I'm finally swapping SCHD into a new value ETF that I believe has more upside over the next decade. If you've been following this channel, you know I don't make changes lightly. I'm all about long-term conviction, strong fundamentals, and getting the best risk-adjusted returns. But the market conditions have shifted, the dividend landscape is tightening, and valuations in certain corners of the market are creating a once-in-a-cycle opportunity. That's why today, I'm walking you through exactly what pushed me to make this move, why SCHD is no longer my top value ETF, and why this new fund might be one of the most powerful performers going forward. So let's rewind for a second. SCHD, Charles Schwab's Dividend Equity ETF, has been the darling of income investors for years. It's loved for the dividend growth, the quality screens, the strong fundamentals, and its historical outperformance. I've personally made great returns with SCHD, especially during sideways markets and down cycles. But something changed around 2023 and 2024 that caused SCHD's growth engine to slow down. A combination of dividend policy changes, sector concentration issues, and macroeconomic pressure pushed SCHD into a period of underperformance relative to other factor ETFs. Over the last couple of years, many investors started noticing something unusual. Despite SCHD's amazing long-term record, it wasn't keeping up with the broader markets anymore. It wasn't beating the S&P, it wasn't beating the Nasdaq, and it wasn't even beating some competing value ETFs that used very similar methodologies. Now, this doesn't mean SCHD is bad, it's still great. But we're not here to settle for great, we're here to maximize gains, especially in a shifting market environment. And what's happening right now is a rare multi-year setup where high-quality value stocks are positioned to outperform. So after months of reviewing data, evaluating historical performance, analyzing interest rate cycles, dividend projections, and even sector rotation models, I ended up making a decision I didn't think I'd make this soon. I swapped my SCHD position into a different value ETF that I believe offers more growth potential, stronger valuation metrics, and better structural positioning for the next phase of this market cycle. I'll reveal the ETF in just a moment, but first let me explain the key reasons behind the move. I always make decisions based on data, not emotions, and when I look at the numbers, SCHD's biggest weakness right now is its heavy focus in sectors that struggle in high-rate or post-rate hike environments. SCHD has big weight in financials, consumer staples, and industrials. These are steady sectors, but they're not high growth in environments where technology, energy, and cyclical value names are dominating. Meanwhile, SCHD's dividend growth slowed down substantially. Its 10-year historical dividend growth rate was strong, but more recent years saw that growth cool off. If dividend growth doesn't keep pace with market returns, total return suffers, and that's exactly what we've seen. Another issue is concentration. SCHD only holds around 100 stocks, which is fine in theory, but many of them come from the same categories. That means if just a handful of companies slow down, the whole ETF slows down. And that's exactly what happened. Not to mention the fund's rules limit its exposure to some of the newer, fast-growing dividend players that could offer better upside. The ETF I'm switching into is more diversified, more balanced, and includes companies that are both undervalued and poised for strong future earnings growth. I'm talking about the Vanguard Value ETF, VTV. This is the ETF that, in my analysis, gives me the best combination of high-quality value exposure, broad diversification, strong forward earnings potential, and a history of outperforming SCHD in multiple market cycles. And yes, VTV has actually beaten SCHD in several important time periods, especially in environments similar to what we're entering right now. Now, let me break down why VTV is the better pick for my portfolio moving forward. First, VTV has massive diversification. Instead of holding around 100 stocks like SCHD, VTV holds over 350, giving you exposure to a far wider base of undervalued companies. This means no single company or sector can drag down the entire portfolio the way it sometimes did with SCHD. And because VTV tracks the CRSP US Large Cap Value Index, it naturally adjusts for market shifts, bringing in new companies and updating weightings as conditions change. That built-in adaptability is powerful. Second, VTV has exposure to some of the biggest high-quality companies in America, companies that SCHD is not always able to include due to its strict screening rules. We're talking about names like Berkshire Hathaway, JP Morgan Chase, ExxonMobil, United Health, and more. These companies might not always be high dividend payers, but they offer a combination of steady earnings, strong balance sheets, and long-term compounding that I think will outperform SCHD over the next 5 to 10 years. Third, VTV offers better sector balance. SCHD leans heavily on just a few categories, while VTV spreads exposure across financials, healthcare, energy, industrials, and even some tech-related value companies. That wider sector distribution gives you better resilience during downturns and stronger performance during rotations, something I value big time in the current environment. Another factor is valuation. When I compare SCHD and VTV side by side using metrics like forward PE, price to book, price to sales, and earnings yield, VTV consistently comes out as the better value. This is huge because valuation is one of the strongest predictors of long-term returns. When you enter a position at the right valuation, you're essentially lowering your long-term risk while increasing your potential upside. That's what VTV gives me right now. But the biggest reason I'm making the switch: market timing based on macro conditions. We're entering a period where inflation is slowing, rate cuts are approaching, and economic growth is expected to slow but stay positive. This is the environment where high-quality large-cap value tends to shine. Dividend-focused ETFs like SCHD do well in stability-focused markets, but broad value ETFs like VTV do exceptionally well during early and mid-cycle expansions, especially when money rotates away from speculative growth. In other words, we're entering a perfect moment for value to outperform, and VTV is positioned better than SCHD for that kind of rotation. I'm not the only one who sees this. If you look at institutional flows, hedge fund positioning, and analyst expectations, value-focused funds are receiving more attention than they have in years. We're seeing strong earnings forecasts from energy, healthcare, and financial companies, all sectors with big exposure in VTV. Now, does this mean SCHD is done? Of course not. SCHD is still a great ETF with a long-term track record that most funds would kill for. And if your focus is purely dividends, SCHD is still near the top of the list. But as an investor looking for total return, growth potential, diversified risk, and macro positioning, VTV fits my strategy better for the next decade. Let's talk performance comparisons. Over the last 10 years, SCHD has been a beast, no question. But the last 3 years, VTV has held more steady, and its forward projections outperform SCHD according to multiple financial models. If dividend growth slows, SCHD's total return slows. VTV doesn't rely solely on dividends, it relies on undervalued companies compounding earnings. That's a big difference. When I ran historical simulations and hypothetical allocations, VTV outperformed SCHD in more scenarios involving rate cuts, energy expansion, and tech value recovery, 3 key market events I believe will define the next decade. Another difference is tax efficiency. SCHD's high dividend distributions can be costly in taxable accounts, while VTV tends to distribute less, meaning you keep more of your money compounding inside the fund. That matters, especially over long periods. Let's also talk about volatility. SCHD isn't a high volatility ETF, but its concentration can make it more sensitive to sector moves. VTV's broader base lowers volatility and gives you smoother performance across cycles. That consistency is huge for long-term compounders like me. So what does this mean for my portfolio? It means I'm not abandoning dividends, I'm simply optimizing for total return and future growth. I'm not selling SCHD because it's bad. I'm reallocating to VTV because the future looks better there. I still believe in dividend investing, but I also believe in adapting to market conditions. And right now, value is where I want to be. I've already swapped my position, and I'll keep you updated over the next months as I track performance, compare returns, and analyze changes. I want to see how VTV performs in real time, not just on paper, and I'll share everything with you here on the channel. If you're considering making a move like this, always remember that everyone's financial situation is different. Your time horizon, risk tolerance, and investing goals matter. Don't simply copy my strategy. Use this information, research more, compare your own portfolio, and make the decision that fits your goals. But I will say this: if you're looking for long-term upside, better diversification, lower risk, and stronger macro alignment, VTV is absolutely worth a serious look. As for me, I'm excited. This is the first time in a long time that I've felt this confident about swapping a major ETF position. It's not easy selling a fund you've held for years, especially one like SCHD that treated me well. But investing is not about loyalty, it's about performance, data, and long-term outcomes. And right now, all signs point to VTV being the better value play. Going forward, I'll be making more videos comparing SCHD, VTV, VYM, DVY, and other value ETFs so you can see how they stack up. I'll also do breakdowns of top holdings, upcoming earnings, and sector performance so you can stay ahead of the curve. If you want more deep dive ETF content like this, subscribe to the channel and turn on notifications so you never miss an update. Thank you for watching, thank you for supporting the channel, and stay tuned for more insights from Stock Predictor. Let me know in the comments whether you agree with my swap from SCHD to VTV, or if you think there's an even better ETF for value investors in 2026 and beyond. I love reading your thoughts, and your opinions help shape future videos. I'll see you in the next one.